Let's get more from Robert Schein. He is Chief Investment Officer at Blanke Schein Wealth Management. Thank you very much indeed for joining us. Could you start off with this move up in bond yields? What do you think is behind it?
Yeah, we're seeing, gold is up, bond yields are up. There's still the question and the concern that inflation is still there. And that means that the Fed still might have some more work to do. But I think, the day after the election, we'll get another Fed rate cut. But as of right now, yields are backing up.
And are people concerned about inflation? Is that the reason?
Yeah, so 87% of the time, historically speaking, in the last 5 inflation bouts, we've seen a resurgence of inflation. So it's not a concern that's out of bounds by any stretch of the imagination. It just takes years to get there. I think we're still on the downward trajectory. If you look at some of the numbers that have come out, the trend is still on the side of inflation coming down. But let's keep in mind, it still had a high number to begin with. So this trend, there's still a lot more work to do on the inflation front, just for every single day of Americans.
We know people are hurting, okay. So your take is that the Fed, after the November 5th election, will cut again?
Yes, we believe we're going to see 25, not 50. But we still think that there's a lot of, pressure that's built up on the consumer, even though the consumer is held in there quite significantly. And we're seeing that play out in corporate earnings as well, that the consumer is solid, but there is a lot of pressure of this long and variable effect, the lag effect of higher interest rates. And so that's playing out for sure.
Looking at the broad market, you think some investors are in cash, but there's a risk they'll overstay their welcome there?
Now's the time. So, historically speaking, cash has always been not at these levels that we've seen. So what that tells us is that the consumer is sort of in that wait and see, suspended animation. Obviously, we've got a lot of geopolitical events going on, but more importantly, less than just about 2 weeks away in the U.S. for the election here. So once we get past the election, we believe that, it's time to basically put cash to work today. I wouldn't wait 2 weeks from today because, again, like I said, the interest rates are going to be dropped in the United States. Lock in term, lock in duration, but cash in the next 12 months would probably one of underperforming asset class.
We've seen oil. It struggled last week, as you know, fell about 8%. We did see it move briefly above $70 this morning. Right now, it's back above $70. Do you think the market is complacent about the violence, the conflict in the Middle East, and the risk to supply?
Most definitely. And there's a lot more levers that are being pulled, even with the geopolitical disruption over the last 2.5, 3 years that we've seen. Oil markets have taken that in stride. Now, again, fast forward, it's a 50-50 race right now in the United States. If we have, let's say, a Trump presidency, he's going to drill, and that's going to put more pressure or bring down the price of oil. So right now, it's short-term concern of the geopolitical risk that you're seeing. But the oil markets the last 2-3 years, oil should be at $100 a barrel. But it's amazing how it's taken this in stride. So I think the more the pressure is for oil to be coming down in the future, based upon all the levers that could be pulled in the oil markets. But it remains to be seen how this will play out.
You say oil should be $100. You mean in terms of economic fundamentals or supply?
All of the above, even the demand out there and the growth of the economies that we're seeing. We don't have enough energy, whether it's, even traditional versus EV energy. The globe is growing. And so although we can turn on supply, there's a lot more demand out there. So there's that inherent imbalance, if you will, structurally.
What about classic cyclicals like copper, or using copper as an example, or zinc? Would you be interested in base metal miners right now? They would tend to do well, of course, if China recovers, for example.
Yeah, China is big in that space in terms of the story as it relates to sort of do the miners, does copper continue? Copper has always been a gauge of the global economy. But we're seeing, obviously gold, maybe silver pick up a little bit, but gold is the show today. And that's simply just the old fashioned inflation hedge that we're seeing. So, but if we do see, like you stated, if we see China sort of pulling their own weight, second largest economy in the world, as well as the U.S. maintain, we could see a case for metals as well.
And what you touched on, well, we touched on retail investors and their cash, but also consumers. Do you think the U.S. consumer is a good bet right now? Would you be interested in, say, discretionary apparel companies, for example?
Yeah, absolutely. There's a lot of great discretionary companies that are, consumer-based, consumer-driven, that are still discounted year to date with relative to the S&P 500. So there's a lot of opportunities out there. One of the things I've learned many, many years in this industry is an economist said, don't ever bet against the U.S. consumer. Mm-hmm. And whether it's a recession, whether it's booming times in the economy, that economist was 100% right. So the consumer is going to find a way. Plus, think about this. If you have rate cuts continue their trajectory on the downside, there's $44 trillion of untapped equity in the U.S. housing market, which again can add more fuel to the fire in addition to the cash on the sidelines for the consumer.
We're going to take a break. Robert has very kindly agreed to stay with us for a second session after this, and we're going to have a look at a couple of stocks that he likes the look of. Robert Schein is back with us. He says that with many tech stocks trading at big discounts right now, he sees it as an entry opportunity, including for Tesla. Well, let's start off with Tesla if we could. You reckon Tesla is cheap, Robert?
Tesla's a story that is, today versus tomorrow. Today is what matters, meaning later this week on their earnings call. Tomorrow, Elon Musk, sold the future of what it could be. Last week, it was kind of disappointing, if you will. Stock, backed up a little bit. But if you look at Tesla over the last 1 year and 3 years relative to the S&P, you got about a 50% discount, meaning that you've, could have been better off by 50% by being the S&P 500. That being said, if Tesla returns to the profit margins and returns to the EV sort of demand market, giving us an update on that, relative to everything else, Tesla's at a discount right now, and it looks very attractive.
You have another idea for us, Amazon, the company we love to hate. I guess it's just so convenient, but it does hollow out other retailers. What has Amazon got going for us right now?
Like Tesla, Amazon is also a big discount over the 1 and the 3 year relative to the S&P 500. In fact, you have the opportunity to have probably one of the best stories for 2025, we believe, is Amazon. The reason why is AWS is really reaccelerating. The profit margins internally of Amazon, it continues to get more and more efficiency. So the efficiency's there, and all different business units are now firing on all cylinders. So Amazon looks attractive relative to those two, relative to, your Magnificent Seven are the laggers, and we believe that they have room to run.
That's interesting. By your numbers, it just hasn't got the shine that the other Mag 7 stocks have right now.
Well, it hadn't, but now moving forward, we believe that the valuations and the price look attractive. So, yeah, relative to, and then looking forward, quite frankly, they just haven't participated. And so, both companies have, worked on cost cutting, and that's going to help the profit margins and the profitability that we've seen from the other companies. But there's a lot of value in the marketplace overall relative to the Magnificent Seven. So, yeah, we're encouraged by the equity market.
And you have a final idea for us, not tech, but Home Depot. Now, we touched on the U.S. consumer earlier, of course, a great engine of consumption, but Home Depot stock is up. Oh, I didn't know it was up that much, 41% in the past year.
Yeah, it's on a good run, backed off a little bit from all-time highs. Home Depot is going to continue to run. Again, this is another story. The 3-year number on Home Depot is still negative to the S&P 500, relatively speaking, meaning that there's room to run. And the reason why is, as I said before, $44 trillion of untapped consumer wealth. As interest rates are pulled down, consumers can go, look at that for some excess capital. And then 70% of all the homes in the United States today are over 25 years old. So the replacement, rebuild, refurbish cycle that's a $1 trillion home improvement market that Home Depot is number one in the category, and they're going to continue as consumers continue just to settle in and nest and take care of their homes, as there's a lot of deferred maintenance out there. So it's a great, solid business model. They're going to continue to execute.
What about the restaurant stocks or the fast food stocks? I'm thinking about McDonald's, MCD, or restaurant brands, QSR. We know that consumers have been horrified by the rise in food prices, including the price of fast food.
Yeah, like anything else, I think that you're going to have clear winners and clear losers. And what's going to separate that are those companies that have the ability to integrate AI quicker and faster. So those efficiencies across the business model. And then you're also seeing a lot of these companies do, bring in the consumer and get the consumer loyalty through apps. Mm-hmm. So they'll throw out the coupon of the day, and they'll be able to drive demand that way. So if they use technology in the right way, even though there's rising wage price pressures, mm-hmm. rising inputs from food, there's still the efficiencies of scale and abilities for these companies to do that. So those companies that can execute on that will win out in the long run.
You mentioned apps. Starbucks has long been a leader. They get people to order outside the store and they go pick up their drink. It all adds up to more strain on the baristas, apparently. What about Starbucks? Would that be a stock you're interested in?
It's funny about Starbucks. I was just in a airport the other day, and everyone was waiting for their mobile app delivery on Starbucks, but nobody was actually in the physical line. And I said, excuse me, is anybody waiting? Nobody was. So I went up and I ordered, and everyone looked at me, and I got my coffee before everybody else. So I think we're a little bit over too much on one side, because I got the best service by doing it the old fashioned way. So there's a balance that has to happen. I think customer service is still key in this world that we live in today. But I was just shocked that I was able to go right past everybody, and everyone's mobile order was taking at least 15, 20 minutes from what I gather. But yeah, the technology's out there, but companies have to figure out the best way to use it to, again, incentivize customers and drive demand. But I think those best breed companies like a Starbucks, like a McDonald's, even Domino's Pizza will figure that out, and they're going to continue to do well for many, many years. It's
going to be interesting, isn't it? If companies want us to deal with their AI chatbots, I guess the legalities will have to be worked out. If the chatbot tells us something, can we rely, the company gave me this undertaking, this commitment?
Yeah, I think we're going to eventually get to old school is new school. So customer service is what we do at our firm is we pick up the phone. Even though AI is great and there's going to be, room for it, you have to basically parse out where the best part of your business model you can actually integrate that, where it's going to be efficiencies. Yeah, I don't trust the chat bots. I don't know about you, but I like picking up the phone, and I like talking to people.
Yeah, I'm old school that way as well. Thank you very much, Robert. It's great hearing from you.
Thank you for having me.
Robert Schein, Chief Investment Officer at Blanke Schein, a Wealth Management.